Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. I've spoken to him many times throughout the years. He's one of my friends that I bounce investing ideas off of. He's Jason Hamlin. He's the founder of Gold Stock Bull. Here's his brief bio. Mr. Hamlin has a background analyzing charts and trends for the world's largest market research company. He's versed in fundamental and technical analysis and has consulted to Fortune 500 companies around the globe. Jason is a cycles investor, student of Austrian economics, and speaks regularly at investment conferences throughout North America. The Gold Stock Bull newsletter is focused on finding junior mining companies that are undervalued relative to their peers, and also energy and agriculture stocks. Thank you for joining me, Jason.
Thanks for having me. Good to talk with you.
Now, Jason, based on your cycles work, what's your opinion about the cyclical bear market in gold being over?
Well, I'm looking at the 7-year cycle and looking at a lot of things that are going on with the stock market, and then I'm looking at past corrections in the gold market in terms of the length of the correction and the severity of the correction. These different data points give me some kind of target in 2015 as being the bottom. I think we most likely already touched the bottom, and I'm looking for a breakout at some point before the end of the year. But the length of this correction and consolidation has definitely lasted quite a bit longer than I had anticipated, and I think it took a lot of gold bulls by shock, how deep it's gone and how long it's lasted.
Yeah, I agree. It's been longer than anticipated. I think there's been a lot of, underhanded stuff done, whether it's painting the tape with charts or these investment banks coming out with negative research report after negative research report, or, anytime gold goes down $5 or $10, you see these people on CNBC and Bloomberg saying, gold's going below 1,000 just to scare people to try to panic sell.
Right.
It's pretty ridiculous. But if you actually look at the chart, and I'm talking the long-term chart, I have the Sprott Gold Miner ETF chart up, and it looks to me, and I'm sure this looks on other long-term gold charts too, it looks like we started to put a pretty strong bottom in November of 2014. I know, there were other areas where it looked like there was a bottom in, but we have to get to a point here where reality has to come into play, where the people who actually mine the gold and silver, right, they have to be able to make a profit at some point.
That's right, and that's another sign that I think that we most likely, hit a bottom in the market. You can buy it for less than it costs to mine it and dig it out of the ground and refine it, there's something that's not quite right with that situation. And there aren't many examples in history where you can go and look at a product, particularly a commodity, that you can go out and buy for less than the cost to produce it. I mean, that's a situation that can't be sustained, and what happens, and what I think we're starting to see happening, another bullish trend for precious metals is, a lot of miners are being forced to suspend operations, shut down their mines, decrease their exploration budgets, and so I think we're going to start seeing supply drop, and for quite a number of years actually, because it takes a lot of time and a lot of capital to get the mines back up and running. So as worldwide production declines, and we know that demand has remained relatively strong, particularly central bank demand, but investment demand as well, there has to be some kind of push on prices back higher. And like you said, to a point where these producers can make some kind of a profit. I mean, the margin compression has been pretty severe to this point. So yeah, that's another indication in my mind that we're most likely have seen the bottom or close to it.
Yeah, I think that's one of the major signs. And, I speak a lot of time talking about, watch the miners, see if they start shutting down mines. We've seen the miners cut, a good amount of them have cut production costs, I would say, in the last 18 to 24 months, 30, maybe 40%. But from talking to my contacts in the mining industry, newsletter writers, other newsletter writers like yourself, and financiers of mining companies in Vancouver and Toronto that I've interviewed, there's really not many more expenses to cut at the mine. So, they've high-graded the mine. They've done other cost cuts, like you mentioned. Maybe they could fire some more, middle-level managers if they're a larger miner like a Barrick Gold or a Newmont or something like that. But the smaller and medium-sized companies, they've cut almost all the fat off the bone. They're starting to trim the bone off in a lot of cases. And we've gotten to the point here where now I don't think there's really many more. If we see, $15 silver or below, or we see gold break below $11.50 or stay down there for a while, we're going to start to see mines put on care and maintenance. And these are even the mines that are where gold and silver are the byproduct because the copper price has come down so much. And a lot of these miners, Jason, unlike the shale oil producers who were hedged and still had some profits because of hedging, we didn't see a lot of these miners hedged. So, they were caught really off guard too when this correction started in 2011.
Yeah, overall, I think it's really good for the industry because it's sort of, forced some of these miners with bloated costs and inefficient operations to go back to the drawing board and to reduce costs to, as low as they can get it, down to the bone, as you said. So I think that's good overall, and they've certainly benefited from this short-term dip in energy prices. I don't know how long that can last. I don't suspect that they'll stay as low as they are too much longer, so I wouldn't count on that as being a place to look for margin for the miners. But anytime I think about this correction, and certainly I think most gold investors have had to do a lot of soul searching, over the past few years, I always go back to, there's a list of 10 or 12 fundamental reasons why initially I was convinced to start investing in gold, back around 2001, 2002. And I go through that list and I check them off one by one, and I'm looking, has my investment thesis changed? Is there some reason that I should be switching from bullish to bearish on this? And almost every one of the fundamental factors is as severe, and in most cases more severe than it was back then. So it's hard to agree with those that say that the bull market's over and that gold's headed down to 700, the Harry Dents of the world. Everything that I look at suggests that it's going back up, and it certainly tested the patience of gold investors. And, I think in the end, those that are willing to run against the herd, that are willing to see this dip as a buying opportunity, are going to be rewarded handsomely. And I think, not only in precious metals, but particularly in the mining stocks, if you just chart the A2I versus gold and look at how undervalued the mining stocks are relative to the metals, you get some kind of indication of what the upside potential could be in some of these mining stocks. I mean, at this point in time, mining stocks are more undervalued versus the metals than they've been at any point in this entire bull market, going back to 2001. So if you're good at picking the junior stocks that have the high grades, that are in politically stable jurisdictions, they have sound management, access to capital, strong balance sheets, a good growth profile, good projects, you can kind of tick all of those boxes and go through and do your research and start buying now on the cheap. I think there's going to be a lot of wealth created over the next, say, 3 to 5 years in this market. And I think we're going to start to see finally see a breakout at some point before the end of the year.
Yeah, I agree. The fundamentals look very good, and we see real demand, according to Kuz Jansen and Bullion Star, real demand out of China and Russia, the Middle East, and India. It's very strong for gold and for silver. But these other asset prices, Jason, whether it's bonds or it's real estate prices in most areas, or it's the general stock market indices, it's the twilight zone. Yeah. When like the headlines may look good for some of these data points, whether it's the job numbers, the payroll data that came out today, or GDP, or some of these things. But when you dig down deep, I mean, there's just rot there, and yet the asset prices just keep going higher. And what you and me see rationally should happen, it's not really happening in the asset prices.
Yeah, no, I think precious metals remains one of the few areas that's not completely in a bubble. That's not, that's still undervalued, and where you can still expect to get a good return. I mean, you look at the bond market, you look at the stock market, by almost any kind of measure that you look at, it's overvalued. I've seen some interesting charts recently on the New York Stock Exchange margin debt, and taking a look historically at when margin debt spikes, and then that being a leading indicator of a stock market correction. And right now it's at the highest levels on record, above 350%. Rejection of credit applications was another interesting data point I came across recently, which had the highest month on record just recently. So there's all these sort of warning signs flashing, and I think most investors are kind of not paying attention. They're in this bliss and think that the stocks can keep going up forever. But whether it's the Baltic Dry Index is another one that we track, dropping to levels lower than during the depths of the financial crisis. So uh, there are lots of, real estate market, stock market, like you said, that are, and to some degree the employment market, but yeah, digging deeper, labor force participation is still an issue, wage growth still an issue. But there are a lot of things signaling to people that, hey, everything's healthy, but you don't have to dig too deep below the surface to really find plenty of data points that suggest that something else is going on beneath the scenes. And I think it's a time to be cautious. It's a time to tighten your stops. It's a time to have some cash available and to take advantage of depressed prices and things like precious metals.
Now, in terms of gold stocks, and you do cover them, what types of gold stocks do you like right now? Is there a specific type? Do you like the larger miners? Do you like the mid-tier producers? Do you like the royalty and streaming companies? Do you like the prospect developers? What types of companies in the space do you think are the best?
Yeah, well, as a cycles investor, it really all depends on where we are in the cycle. I mean, on the way down here over these last several years, we've held on to core positions, which have been primarily royalty stocks, which can weather the storm quite a bit better than some of the junior miners. Now that we've reached a point where I think we most likely hit a bottom, I think it's time to start going a little more aggressive into some of the junior miners and near-term producers or companies that are in production but have plans to grow production significantly in the coming years. So that list of criteria I mentioned earlier, I try to go through those every time I evaluate a company, and I try to get on the phone with management and talk through as many questions as I can with them, as many pain points in their company, potential downsides, and try to get to the root of what's going on with the company and what they're expecting into the future.
Yeah, I think that's important. One of the things I interviewed Keith Neumeier for Majestic Silver. He told me, trying to predict the silver price or the gold price if you're a gold miner is very difficult. The only thing these miners can really control are their costs. So I think one of the things that the mining that was exposed really since 2011 is a lot of these miners didn't have their costs in order. So when the metals price kept rising during the secular bull market, the costs kept exploding. So these weren't efficiently run businesses, consistently generating free cash flow like you would have thought some of these miners would have generated when gold was at $1,900 and silver was at $48 or $50.
Right, and to some extent they didn't really need to be because prices were appreciating so rapidly that you could run the company really poorly and still have positive cash flow and earnings. So those times were fun and exciting, and now it's time to sort of tighten the bootstraps and do the right things for the company to repair the balance sheet and bring costs down and cut the fat. And so, like I said, I think that's going to be a real positive for the industry as a whole. I like to have exposure to some of the big guys, some of the royalty companies, and then some of the mid-tier and some of the juniors as well. So we're pretty diverse across the portfolio in terms of the companies that we like. I can mention a couple that I've been excited about recently. These are companies on our target list, which we're looking to pick up at the right signal. We don't currently have them in the portfolio, but two companies that I think warrant further investigation for investors, and the numbers certainly suggest that they're going to have a positive future. For producers, one is Kirkland Lake Gold. Eric Sprott's the chairman. He owns 10% of the company. I'm a big fan of grades, and this is one of the highest grade gold mines in the world. It's in a minely friendly jurisdiction in Canada, and they're expecting 155,000 ounces of gold production this year, which is about roughly 30% growth versus 2014. And that's a really strong growth level for an established producer. Their ASIC's at about $1,150, which isn't the best in the industry, but it's profitable, and their stock's up 80% year to date. So it's been performing, and I think it has a lot higher to go. So I'd encourage your listeners to check into Kirkland Lake Gold. And on the exploration side of things, a company really just started researching recently, and like a lot, is called Red Eagle Mining. And they have a Santa Rosa gold project in Colombia with a feasibility that outlines around 50,000 ounces a year and, IRR of 53%, which is, one of the highest I've seen, especially lately. You don't tend to get return levels of that high in a feasibility study. And the NPV is over 100 million, and that's at 1,300 gold. They're fully permitted. They have a credit facility to construct the mine, and their AISC is 763, which I gotta believe is one of the lowest in the industry. You rarely see all-in sustaining costs that low. So they're looking to go into production later next year. There's high inside ownership, which is another key metric that I look for. And they have strong strategic shareholders in Liberty Metals and Orion. 30 million market cap, so I think there's huge potential in Red Eagle as well. So that's another stock kind of on our radar.
Yeah, there's just not many gold mines that are ready to go into production that have low all-in sustaining costs. Most of the feasibility studies, Jason, of mines that were brought online since 2009, they have much higher gold and silver prices than current spot prices. So the miners have been scrambling. They sunk in a lot of capital, many billions total, into mines that are not economic anymore. Maybe they've cut the cost to the bone. So yeah, once in a while you can find like one of the ones you mentioned, or True Gold, although, a company like True Gold, even though on paper the mine looks great with the low all-in sustaining costs, they're in Burkina Faso in Africa. You're taking a lot of geopolitical risk. So normally to get like those low-cost mines with higher grades now, it's tough to find those in a politically stable country.
Absolutely. And, another thing that we've been doing is kind of diversifying into other sectors over the last few years. I mean, we're looking in agriculture and energy, and even been having a lot of success in the tech sector. I started a separate newsletter at techstockbull.com, and it's exciting to kind of branch out and start to cover some different areas while the gold bull market is sort of resting here. And we've been able to identify a couple of huge winners. Our latest one, which I think is really interesting. With the drought here in California, I'm based in Southern California. I started looking at water. I was thinking, wow, this has got to be a resource that's going to become increasingly valuable over the years. And how can I get exposure? And one of the companies I came across is called Two Rivers Water and Farming, and they own water rights in Colorado. That's where the majority of the water for the Southwest comes from the Rocky Mountains runoff. And so they went around and bought up water rights and farmland, and then they go in and convert the farmland from low margin crops into higher margin crops. And they sell the water downstream to residents. They use the water for their crops, and they're producing food, which right now food prices have been trending lower, but in the long term, I think they're only going higher. So it's kind of neat that it gives you exposure to water and to agriculture. And then the third leg of the company, which just got going recently, is they're building greenhouses on their land and leasing it out to cannabis farmers, which is the highest margin of all the services and products that they're doing. And it's really interesting because no one else in the industry in Colorado is really doing this. They're using like legacy skill sets where they convert a warehouse, and it's just not very efficient. So here, this company, Two Rivers, and the ticker's TURV, is using the sun and using the water that they have there in place, and they claim they can double the production rates at about half the cost. So they're completely changing the industry, and they're the largest greenhouse grower in Colorado at the time. And, the cannabis industry is in its infancy still, so legally at least. And so I think that's another exciting space to be in. We picked up their shares around 50 cents a month and a half ago, and it went up towards $1 just recently. So while the gold market is sort of languishing and bouncing around, consolidating in this range, it's been good for us to kind of take a deeper look into other sectors and try to spot profitable opportunities elsewhere.
Yeah, I think some I'm a gold bug, but I'm not putting, and I'm a silver bug too, but I'm not putting all my money into physical precious metals and storing it, in my backyard, digging a hole,
right,
or just buying mining stocks, gold and silver miners, because I think it's dangerous, Jason, in this environment that we're in, where politicians can change the rules, governments are, doing currency wars or coordinating quantitative easing programs, to go all in on anything, go all in on rental properties or go all in on metal. I think to look for different inflation hedges, whether it's owning ammunition or investing in water or investing in other ideas. Even technology at the right valuation is reasonable as long as you're not buying, one of these ridiculous social media stocks with no barely any revenues and no profits or anything like that. If you can buy, really quality technology company that's actually generating, revenue and earnings and stuff like that at a good valuation, and they're going to grow their business, I don't see a problem with that as, a little bit of diversification away from owning precious metals.
Absolutely. You have to adjust to what's going on in the market. And I certainly was less diversified, 5 or 6 years ago.
Me too. I learned the hard way, but, I've adapted now to the point where I didn't think things were going to stay. I didn't think they'd be able to keep the whole global financial system together this long, right. And yet they've done it with, different schemes and stuff.
Yeah, it's amazing. And that's the key quality to survival in life, financially or elsewhere, is adaptability, I think. So you have to kind of roll with what's going on. In the tech space in particular, I agree, the valuations have gotten pretty ridiculous lately. Watching Uber's valuation or Snapchat and Slack.com just like doubled from 1.5 to 3 billion within a month. And it's almost reminiscent of 2000, right? I moved out to California initially to take a tech job in Silicon Valley, so I got to sort of experience the inflating and bursting of the bubble firsthand, and it was quite a ride to be on. So I'm a little more discerning these days picking tech stocks, and I think one sector, if people are looking for an idea that does have a lot of promise and solid revenues and isn't built on just an idea, is cybersecurity. And particularly with this latest federal government security breach, but also, Home Depot and Target and all of these massive corporations, the breaches and all of the hits that they've taken, looking into cybersecurity stocks that have the, best in industry kind of practices, and they're at the head of the game. Stocks like Fortinet or which is FTNT, or FireEye or Palo Alto Networks. Things along that sector, I think, are going to have plenty of growth ahead because, this is an emerging sector that all levels across government and corporations are going to have to beef up their cybersecurity. So I think it's a good field to be in, and I think it's a good field to be invested in as well.
Yeah, and large corporations in the United States and U.S. consumers are drastically underinvested, in my opinion, at protecting their data. And it pretty much seems, Jason, that almost every day we see one major news story about a major security breach, whether it's a government or a large corporation or et cetera, et cetera. I think even the IRS got hacked recently. So are you familiar with the cybersecurity ETF hack, HACK?
I just read about that recently. It holds a handful of different companies like that, right?
Yeah, actually, I've had Andrew Chanin on from Pure Fund's Silver Juniors ETF. He launched the cybersecurity ETF too, so maybe I'll have him on in the near future to discuss the cybersecurity ETF as well. But for people, either they could buy the ETF or they could pay for your newsletter and you'll pick out the stocks for them.
Right. I mean, it's if you have the time and you have the analytic abilities and inclination to want to do that kind of stuff, certainly any investor can put that time in and do it. And what we try to do is do a lot of that work up front for people and sort of provide some of the data and research and ideas, and then they can choose and pick what resonates with them, what makes sense, and go for it. And like I said, I cover, everything from precious metals across to tech. And so there's lots of different sectors that people may be interested in.
Well, I just want to thank you for your time today. Have you back on in the near future when hopefully gold stocks are higher and we could talk other investing ideas. I do enjoy bouncing ideas off of you. When I was in law school, it was important to discuss concepts with other law school classmates and stuff like that, and I think you do that with me with our investing ideas.
Same here, Jason. I really enjoy it. So yeah, let's keep in touch and do it again soon.
And how do our listeners then check out your articles and your website?
Goldstockbull.com, GoldStockbull.com, and the technology newsletter is at techstockbull.com, and that is still free. It's kind of in a founding phase. I said I'd do free the first 100 members, and I've kind of let that go. But yeah, that's currently free if anyone wants to check it out. So Gold Stock Bull and Tech Stock Bull.
Okay, great. Well, thanks again for your time.
Thank you.